Now we're going to talk a bit about risk of misstatement and different types of misstatements that you might see in an audit. So generally we have two kind of classes of misstatements that we consider. One would be misstatements due to error, and the other would be misstatements due to fraud. It's the auditor's job to prevent and detect both types of misstatements if they are material. And really the difference here is intent on the side of the person who caused the misstatement, right? Errors are unintentional misstatements, accidents. Fraud is an intentional misstatement. So somebody deliberately bypassed the controls of the company in order to misstate a given account. Now, there are lots of different causes or drivers of misstatements. So misstatements due to errors or fraud could include things like an inaccuracy. So data was recorded inaccurately. It could also be omission. Something just wasn't included. So an example of omission, right? We talked about, oh, they may just, when they're telling us how much debt they have, they may just leave one of the lenders out, right? And that's just as much an error as if they had included the lender but misstated the amount of the loan. We could also have a financial statement disclosure that isn't presented in accordance with GAAP. So maybe they have a related party transaction, and we know in that case they're supposed to be arm's length and they're supposed to be disclosing it. So maybe they either haven't disclosed it at all, maybe they've disclosed it, but they've made it sound like it's arm's length when it really isn't. We can also have incorrect accounting estimates arising from overlooking or clear misinterpretation of facts. So this sounds like a pretty black and white error, like it's clearly wrong. Or you could have difference in estimates due to judgmental differences on the part of management versus the auditor. And this is more of a gray area, right? Not a clear black and white misstatement, which segues into the next slide, right? We can have misstatements that are clear factual errors, and those are black and white. So like you broke the laws of revenue recognition and are recognizing revenue before you're supposed to. That is pretty clear violation of GAAP. But then there are these judgmental misstatements, which is where we can get into a lot of arguments and disagreements between the client and the auditor. Because in a lot of financial statement estimates, especially things like hard to value assets, you have a ton of assumptions that are going into that final number, right? A ton of assumptions, a ton of judgments. Think about, an estimate where you're having to come up with a model of future cash flows. So you're estimating the future cash flows themselves, you're estimating your discount rate, and then maybe the auditor versus the client disagree on what the discount rate should be. Maybe one thinks it's 5% and one thinks it's 6%. Or possibly you could have them disagree about the future cash flow estimates, right? So maybe management thinks future cash flows related to this item are going to increase by 5% every year. And the auditor thinks really a more accurate estimate would be they're going to increase by 3% every year. So these things are going to just be judgmental differences. And it's really tough to argue with management about them, because if you ask management, well, why do you think it's going to grow at 5% every year? There could be some justification, like historically it's grown at 5%, but they might just say, well, because that's what my gut says. I'm like hearing buzz on the streets and the markets about how people are really excited about this product. And I'm hearing that, my competitors have just been unable to replicate this product. And so because of all those reasons, my gut just says it's going to grow at 5%. So as the auditor, it's especially hard to argue with that, because let's face it, the CEO and CFO, or people coming up with these estimates, do know more about the company and its products than the auditor does. This is just a fact of life, because it is their full-time job to know and understand the products and the company's business. The auditor is going to have a lot of different clients, right? This gives the auditor kind of expertise in a sense, because they know what the industry is doing, they know what is typical, but management tends to be the true expert for their specific company and their specific product lines. So you can have an argument over an assumption like the 5% growth rate versus 3% growth rate, And that argument can just go on endlessly with no real resolution about who is right and who is wrong. So these are the types of misstatements that tend to sit on our summary of audit differences and go unrecorded, right? Because management fundamentally disagrees with them and has no desire to record them. We can also have something called projected misstatements. And this is something we're going to talk more about in Chapter 8 and Chapter 9 when we talk about statistical sampling. And basically what happens is you're going to be sampling generally a small portion of the population, right? So let's say out of AR, I'm sampling 10% of it to test it. And what can happen with the projected misstatement is if I found a 2% error rate in the 10% of AR I tested, I may try to extrapolate that across the whole population and say, well, all of AR must have a 2% error rate. And so therefore you might ask the company to write down AR by 2% based on your 10% sample. So this is a projected misstatement. Again, management tends not to be thrilled by them because they're just based on an estimate, and the ultimate accuracy of the projected misstatement is going to depend on how representative your sample is, how good a job you did with all your sampling procedures. So management, again, tends not to love these because they're not the exact dollar value of, an identified misstatement.